Once we've analyzed the situation, defined our ideas, and planned our measures, we arrive at financial planning. We click on Plan Calculations and start with the balance sheet and income statements. The sheet is from 2018-2022, as we have defined it that way in our business plan. Here again, I suggest you read up on accounting, as this will really help you with your business. But in any case, here's a quick overview of accounting so that we can get started together. Accounting is about balances, so basically the balance sheet. It tells you what will you have left on a given day if you close the company on that day. So we can compare our active assets, which means our surfboard's car, and our passive assets, which is the starting capital given to us by lenders. So ultimately we see that if we sell our company, we will have $9,000 worth of materials, which we'll have to pay back to our lenders. So the net value of our company is zero. The income statement, on the other hand, shows what we project to earn on a given year. So in 2016, we project to earn $70,000, spend $26,000 on materials and services for a gross profit of $44,000, and then, whoops, a loss of $13,000 in the first year, followed by an increase in profits over the following years of activity. And this is what we're hoping. But where do all these numbers come from? We haven't entered any information into this section yet. Well, it comes from the system. You've already entered them into the previous sections. If you aren't using the IFJ Business Plan tool, you can start by using Excel and catch up to us now. But the tool is extremely practical in this regard. The tool has already registered our entries. In strategy, we outlined the products and how many of them we wish to sell every given year. So on our income statement, we can already see the gross profit for every year, calculated automatically. There are also other places where we've already filled in the numbers. In measures, we've already registered our marketing expenses. And these marketing expenses will appear as negative numbers on our income statement. Negative numbers signifying spendings. Let's return to our income statement. Based on our current calculations, we project a 13% loss in the first year. Investors will definitely be upset to hear this, as they will assume that we are already being optimistic. So here's some advice again from me, with my 23 years in business experience. It always takes more time, is more expensive, and requires more energy than expected. Always. So be careful not to be overly optimistic, but also not pessimistic. Try to be a realist, and always listen to advice from your friends. We can also view cash flows in our plan calculations. This simply means when money comes in and when it goes out. Not how, just when. Here we have the planned cash flows for the 2016 to 2020 range. So this indicates whether we are losing or making money. As we see for 2016, we have an 18,000 franc deficit for that year. But how come we only have a 13,000 franc deficit on our income statement? What causes this difference between cash flow and accounting? The answer is the Ford truck that we bought for 5,000 francs. It is counted as part of our wealth on the income statement, but it still represented a 5,000 franc cash flow that we had to pay to get it. So how can we modulate our cash flows to avoid losses at the end of the fiscal year? Well, we have several options. We can invest or divest into various things. We can change the amount of starting capital we have, we can change the amount of loans, and the amount of money we borrow in the cash flow. Say lenders give us $30,000 in capital in our first year of activity. We press save and our end of year deficit becomes a surplus due to the increase in financing activities. Cash flows are a great overview of what's happening, but they do not help with everyday business. For that, you need liquid asset planning. Liquid asset planning shows you exactly when you need money throughout the year. We always do it for the following year. It doesn't make sense to do liquid asset planning more than a year in advance because we don't know how much money we will have at the end of a given year. The business plan tool includes planning for 4 quarters of the next fiscal year. Now, we have to hypothesize in which months we will make our revenue for the year. Over the whole year, we have to make $50,000. We can hypothesize that we make $5,000 in May, in the opening month, and subsequently we can fill in another $5,000 for June, and $20,000 for July, and $14,000 in August, which is the high season. Now, we have spread our expected revenue appropriately throughout the various quarters of the year. Notice that there is no economic activity in the 4th quarter. We can also spread our spending appropriately throughout the year. Now I have to decide when I will be spending throughout the year. So, for the first line, use of third-party services, this means our hotel, I will only need to pay during the months when the customers are here, so between May and August. As for personnel expenses, I can choose to pay them in April and in August. In terms of marketing, I will choose to pay for advertising and promotion between February and April, before the season begins. I will also use that time to do maintenance on the car and repairs and buy new equipment. So that is in February, March, April, and May. I expect to pay my property insurance in April and August. The negative numbers mean that I'm paying money. Now when we save, we see that we have spread our spending over the year. I also choose to spread the lender's capital into 2 separate payments, one in February of $10,000 and one in June of $20,000. Now we see the lender's capital appear in the appropriate quarters. As a quick reminder to what the business plan must answer, it must answer where we are now, what our objective is, how do we get there, and of course the most important one, what does this bring? And this brings us right into ratios. A proper business plan answers the last question numerically. Go to the ratios in the toolbar for growth and asset analysis. Like this, we can verify if your plan is indeed viable and realistic. An investor will be able to view opportunity in your business plan here based on your ratios. So once again, it is important to be realistic and honest. Never hesitate to ask for advice on your finances. The tool also includes valuation in the plan calculations toolbar. We will not discuss it in detail here as this is an advanced accounting topic, but you should look into this yourself with a business partner or with an accountant. You can value your company based on several indicators: discounted cash flow, net asset value, capitalized value, the mean value method, or by EBIT multiples. Here we can view the capitalized value valuation. Using the mean value method, the value of the company at the 5th year is already much smaller. In reality, the actual value of a company is always a question of negotiation. It will depend on your brand value and your recognition, and whether or not investors and customers alike are attracted to your business. Now we're done with numbers. Let's move on to the management summary.